Hello and welcome to our lecture for Auditing and Assurance Services, Chapter 5, where we are going to discuss risk assessment, internal control valuations. So these are our learning objectives, which is basically we're going to discuss internal controls, distinguish the responsibilities of management and auditors, define and describe the 5 basic components of internal control, and then explain the process by which the audit team uses to assess control risk and understand the impact of that risk on material misstatement and how it affects the nature, timing, and extent of future audit procedures. And then we're going to describe any additional responsibilities that management and auditors have that is required by Sarbanes-Oxley and PCAOB Auditing Standards number 2201. And lastly, we're going to communicate the internal control deficiencies to those charged with governance, such as the audit committee and other management personnel. So let's discuss and define what internal control is. So internal control is a process effected by an entity's board of directors, management, and other personnel designed to provide reasonable assurance regarding the achievement of objectives in 3 categories. 1, reliability of financial reporting. 2, effectiveness and efficiency of operations. And 3, compliance with applicable laws and regulations. So now let's talk about both the auditors and the management's responsibility for internal control. So management is responsible for establishing and maintaining adequate internal controls over financial reporting, ICFR. Management is also responsible for assessing and reporting on the effectiveness of internal controls over financial reporting. The auditor's responsibility, especially for public companies, is that the auditor must audit and issue an opinion on the effectiveness of the internal controls over financial reporting. So keep in mind that the auditor now issues 2 opinions, one over the internal controls and another one over the financial statements, hence our integrated audit. The auditor's responsibility is also for fraud risk, where we must evaluate whether controls are in place to mitigate the fraud risk. Lastly, the auditor must assess control risk to determine the nature, timing, and extent of substantive procedures to be performed. So now let's discuss the relationship between internal controls, reliance, and the audit procedures. Here, note that you would have a higher sample size if you have to rely less on the internal controls, and a lower sample size if you have more reliance on internal controls, which means a lower control risk, but a higher detection risk. So now let's talk about COSO, the Committee of Sponsoring Organizations of the National Commission of Fraudulent Financial Reporting, or the Treadway Commission, which includes a group from several other organizations such as the Financial Executives Institute, the American Accounting Association, the Institute of Internal Auditors, the Institute of Management Accountants, and the AICPA, the American Institute of Certified Public Accountant. You can see the COSO website at coso.org. And once you do that, you will see that it is an internal control, is a management process, and it is designed to have objective, specific, and several components. And we're going to discuss the 5 main categories. So here you see that we have control environment, risk assessment, control activities, information and communication, and monitoring. And I like to remember this using crime. So here you'll see the control environment is the E, the risk assessment is the R, the control activities is the C, the information and communications is the I, and the monitoring is the M. And keep in mind that each of these 5 categories or components have 17 principles associated with them. So now you see the control environment is all-encompassing, and we do our risk assessment, then we gain our control procedures, and throughout this process we are doing our information and communication not only with the auditors but with management, and then we have monitoring throughout the whole process. So let's discuss the control environment. That sets the tone at the top of an organization, and it influences the control consciousness of its people. It's the foundation for all other components. So as a result of this foundational element of the control environment, an auditor must obtain a detailed understanding of the control environment, and more importantly, document that understanding in their work papers during field work. So here are the 5 principles of the control environment, right? The organization has to demonstrate a commitment to integrity and ethical values. The board of directors has to demonstrate independence from management, and the board of directors also has to exercise oversight over the development and performance of internal controls. Management establishes with that board oversight the structures, the reporting lines, and the appropriate authorities and responsibilities in the pursuit of those objectives. So the organization then has to demonstrate a commitment to attract, develop, and retain competent individuals in alignment with the organizational goals and objectives. The organization also has to hold individuals accountable for their internal control responsibilities in the pursuit of these objectives. So now let's talk about the audit committee. The audit committee is a subcommittee of the board of directors, and it's generally composed of 3 to 6 outside members of the board. Keep in mind that the board of directors also has a second subcommittee, which is known as a compensation committee. The audit committee provides a buffer between the audit team and operating management. All members must be financially literate, but at least one member must be a financial expert in the audit committee. The audit committee has certain duties like appointment, compensation, and oversight of the public accounting firm that is actually conducting the audit. The audit committee would also provide resolutions of disagreements between management and the audit team. And the audit committee has oversight of the entity's internal audit function. Any approval of non-audit services provided by the public accounting firm must be done through the audit committee. Oversight of the anonymous fraud hotline is also the responsibility of the audit committee, and the authority to engage legal counsel in the event of management fraud falls under the duties of the audit committee. Now let's talk about risk assessment, another category of our COSO framework. So management has to identify, analyze, and kind of look at the relevant risks in order to achieve its objectives, right? And one way that management can do this is through COSO's ERM, Enterprise Risk Management Framework. So here we're going to set management objectives and identify success factors. And then auditors can focus on the risk of material misstatement, especially those risk of material misstatement due to fraud. So now we have the 4 principles of risk assessment. So here the organization specifies objectives with sufficient clarity to enable the identification and assessment of risks related to objectives. The organization identifies risk to the achievement of its objectives across the entity and analyzes the risk as a basis for determining how those risks should be managed. The organization considers the potential for fraud in assessing risk, and the organization identifies and assesses changes that could significantly impact the system of internal controls. Now let's talk about control activities. These are the policies and procedures that help ensure management directives are carried out, such as physical control over the security of assets, segregation of duties, information processing such as approvals and authorizations, verifications and reconciliation, and management review controls. These control activities are designed as either preventive controls or detective controls to prevent the error or fraud or to detect that error or fraud. And now here we have our management assertions such as occurrence, valuation, and completeness, and what can possibly go wrong and how a control activity can help that. So for example, revenue is one of the most audited areas. And here we see that sales revenue is recorded when the goods have not been shipped to the customer, which would violate the occurrence assertion. So in this case, what we can do is we can have all sales invoices that are matched to the shipping documents before recording them in the general ledger. This is known as a 3-way match. You have a sales quote, you have shipping documents, and then you have your invoice. So now let's discuss the 3 principles of the control activities, right? So the organization selects and develops control activities that contribute to that mitigation of risk and that way to an acceptable level. And then the organization selects and develops general control activities over technology to support the achievement of the corporate objectives. The organization also deploys control activities through policies that establish what is expected and procedures that put these policies into action. Now, separation of duties. And then this is incompatible responsibilities. So if we combination of responsibilities that places a person alone in a position to create and conceal misstatement due to frauds or errors in his or her normal job. So we want to avoid this, right? We want to have separation of duties. We want to have several employees do different things. For example, 4 types of functional responsibilities that should be performed by different departments or people are: you want one person to authorize or execute the transaction. You would like another person, ideally, to record those transactions, possibly a third person to have custody of the assets involving those transactions, and lastly, a fourth person to do the reconciliation of the existing assets to the recorded amounts. So segregation of duties forces people to commit fraud through collusion, which is a lot more difficult, right? Because you have to get everybody to agree in order to commit that fraud. It is also one of the easiest to implement controls if there's enough employees. So here we have authorization, custody, recording, and reconciliation, all to hopefully be done by different individuals. Now let's go on to another category of COSO, information and communication. So the auditor must understand the information systems that are relevant to financial reporting. The auditor cannot ever rely on information produced by the company's information systems without investigation. So information systems have to prove like a trail of activities from data identification to financial reports, which is known as the audit trail. And you can visualize with source documents. So the 3 principles of information and communication consists of: the organization has to obtain or generate and use relevant quality information to support the internal control function. The organization internally communicates information such as objectives and responsibilities for internal control necessary to support the internal control function. And the organization communicates with external parties regarding matters that affect internal control. So here we have the occurrence and completeness of a sales transaction, right? So we start with the sales order, we get the authorization, we get the shipping documents and the sales invoice, and then we go to the financial statements. So here you'll see the sales order is our first step, the shipping document is our second step, and then the sales invoice is our third step. So this is our 3-way match to ensure that there is occurrence and completeness in sales revenue. Now moving on to monitoring. A well-functioning monitoring system is characterized by these philosophies: ongoing and separate evaluations and reporting of any deficiencies. So management process that involves ongoing evaluation of the internal controls could include periodic evaluation by the internal auditing department, or a supervisory review of controls, or follow-up of reporting errors or customer complaints, and any inquiries from the audit committee. So the 2 principles around monitoring activities include: the organization has to select, develop, and perform ongoing and or separate evaluations to ascertain whether the components of the internal controls are present and functioning. The organization evaluates and communicates internal control deficiencies in a timely manner to those parties responsible for taking corrective action, which could include senior management and the board of directors. So now we have limitations of internal controls. No system is foolproof, right? So here we have some human error. There could be fraud due to collusion. There could be fraud due to management overrides of any of the internal controls. And then there's our cost-benefit analysis. This is the trade-off between the cost of the effectiveness of internal controls and the benefit that it generates. So here we want reasonable assurance that recognizes that the cost of an entity's internal control should not exceed the benefits that are expected to be derived. So now when we're looking at our internal control evaluation, we have 3 phases. First, we have to understand and document the client's internal control. Secondly, we want to assess control risk. And lastly, we want to identify controls to test and perform a test of controls, which is typically attribute testing. So here we have the phases of our internal control evaluations, as you can see, from phase 1 to phase 3 in this nice, neat flow chart. So in phase 1, we want to understand and document the client's internal control. We want to document the entire understanding, and we want to perform a top-down risk-based kind of functionality where we identify significant accounts and their assertions, and keep in mind these are management assertions, and then account their significance as it's based in inherent risk. So keep in mind that we have audit risk equals control risk times inherent risk times detection risk. Then when we are identifying these entity level controls, right, they have to be pervasive to the internal control system and the reliability of the financial statements taken as a whole. We have then transaction level controls, which are controls that pertain to a specific class of transactions, such as revenues or expenses or leases, account balances, and disclosures. One of the ways that we check these transaction level controls is through walkthroughs, where we take a document and we walk it through. So again, if we go back to our sales revenue transaction, we would take that sales quote and walk it through the process, and that would give us an understanding of how effective the design of that internal control is. So when we are documenting our internal control understanding, the audit team has to document this, and they can be summarized and documented effectively in some either type of narrative descriptions, with questionnaires, or with flowcharts. And here we see a payroll system flowchart where we have the different departments, such as the operating, HR, payroll, and IT, and the whole process through it. So key decisions, whether to continue to test internal controls, right? So an auditor may choose not to test internal controls for several reasons. One is the internal control system is too ineffective in preventing or detecting misstatements to rely upon it to justify reductions in substantive testing. So here the auditor deems that the internal controls are not effective, they are not reliable, and it's really not going to reduce the amount of substantive testing or sampling that we do. And then for audits of non-issuers, it would take more time to test the operating effectiveness of the control activities than it would be to perform an actual substantive testing necessary to have an assertion on that management, or have some assurance on that management assertion. So either it's too ineffective or it would just take more time, are the most common reasons why we would not test internal controls. So now moving on to phase 2, where we are assessing the control risk. Auditors seek to identify internal control activities that are explicitly designed to support reliable financial statement reporting. And then it's for the relevant financial statement assertion, which includes the significant account and the related footnote disclosures. So here we're also considering the cost effectiveness of reliance and testing. And at this stage, auditors have established an assessment of the level of control risk. So now our last phase is to identify controls to test and actually perform them, right? So here we're going to do our test of controls, which is attribute testing. And most of the time it depends on what we're testing, right? We can do all the items in a population, or we can just test from a sample of that population, which is the most common, and that's audit sampling. And then once we perform our test, we reassess control risk. So, test of controls. After we identify the specific control activities that we can be relied upon in order to reduce our substantive testing for any one of the financial statement assertions, we test the control. So there's a hierarchy of types of control tests, from the least pervasive, which is inquiry, to the more persuasive, which is evidence, right? So we would actually talk to the client personnel, but then we want to observe that control activity. Then we want to inspect any documents and possibly re-perform the control activity. And then the direction of how we do this test matters. So here we have a chart which will show you about the payroll cycle that we had a flow chart earlier. And we have, let's say, occurrence, completeness, accuracy, classification, and cutoff. So let's look at cutoff, for example, where payroll-related events have been recorded in the correct accounting period. Here, what we would have is payroll reports that are prepared weekly and transmitted to cost accounting. And then our test of control would be to observe the date of those payroll reports and see if those dates agree with the weekly journal entries. So a simple, easy attribute test of controls. So then we have dual direction test of payroll controls. So not only are we testing from the source document, but to the summary listing. So did we record all of the labor hours accurately, and were they recorded properly? So now let's talk about the responsibilities in the audits of issuers required by the PCAOB, the Public Company Accounting Oversight Board, auditing standard number 2201. Here, the audit team must plan and perform the audit to obtain reasonable assurance about whether the entity maintained effective control over financial reporting. And we have to determine as auditors whether a material weakness exists at the end of the year being reported on. And under Sarbanes-Oxley, SOX, an audit of the internal control system over financial reporting is required. Hence why we have an integrated audit and we issue two opinions. One over the internal controls over financial reporting and the other over the financial statements. So here we have the difference between internal control audits and financial statement audits, right? In an internal control audit, we're just testing relevant control activities each year. We are providing an opinion on the effectiveness of the internal controls, and then we're evaluating that effectiveness of internal control as of the end of the fiscal year. So now we have the audit process as defined by PCAOB Auditing Standard number 2201 to evaluate the effectiveness of the internal controls over financial reporting. So we have to plan the engagement. We want to use a top-down approach. Then we want to test controls. We want to evaluate any identified deficiencies, perform a wrapping up, and then report on our internal controls. So planning the engagement. Here we want to look at significant accounts, locations, and assertions that have to be identified. We want to look at the inherent risk to determine the nature, timing, and extent of these tests of controls. And then we want to evaluate those controls for all relevant assertions and for all significant accounts or significant disclosures. Moving on to step 2, where we're using a top-down approach, we want to focus on the threats to the integrity of external financial reporting process. So we want to identify any entity-level controls that could have a pervasive impact, and we want to identify significant account and disclosures and their related assertions, and then perform a walkthrough. So here is our top-down approach where we begin at the financial statement level, understand the overall risks, then we focus on the entity level controls, anything related to our significant accounts, disclosures, and assertions. Then we want to possibly look at material misstatement, verify our understanding of the process, and then we want to select the test of control that we will perform. So here we're going to actually test controls in our step 3. We decide now as auditors which controls to test, and we want to test operating effectiveness. So typically we take a sample of transactions and it's either examined using inquiry, observation, inspection, and reperformance. And again, inquiries are least persuasive, where reperformances are best persuasive. And the test of controls would not be performed if design is not evaluated as effective. So first, as an auditor, we have to say that the design of the internal controls is effective. So now we want to evaluate identified deficiencies. So our internal control deficiencies exist when the design or the operation of the control does not allow the entity's management or employees to detect or prevent misstatements in a timely fashion. So we have a design deficiency and an operating deficiency. So a design deficiency is a problem relating to either a necessary control that is missing or an existing control that is so poorly designed that it fails to satisfy the control's objective. Whereas an operating deficiency occurs when a properly designed control is either being ignored or inappropriately applied because employees are either poorly trained. So a more serious internal control deficiencies can be categorized into 2 groups. 1, material weaknesses. 2, significant deficiencies. So here, a material weakness is a deficiency or several deficiencies that result in a reasonable possibility that a material misstatement would not be prevented or detected on a timely basis. So then we have indicators of some possible material weaknesses where we have a restatement of previously issued financial statements to correct a material misstatement. We have evidence of material misstatements that were not prevented or detected by the client's internal controls. We have ineffective oversight over the financial reporting process, and we have possibly an indication of fraud, whether it's material or immaterial, by senior management. All examples of material weaknesses. So any significant deficiencies now is a deficiency or combination of deficiencies that could adversely affect the organization's ability to initiate, record, process, and report financial data in the financial statements. And the primary difference between a significant deficiency and a material weakness is usually the magnitude of the potential misstatement that could occur and would not be detected. So now we move on to step 5, where we're wrapping up. And here, auditors issue one of 3 types of opinions on their internal controls over financial reporting. Unqualified, we have no material weaknesses found. We have a disclaimer of opinion, so the audit team cannot perform all of the procedures considered necessary to determine if weaknesses exist. That's usually a limitation of scope. Then we have an adverse opinion, which is we found 1 or more material weaknesses. And then we evaluate management's annual report on internal controls over financial reporting. And our last step is our reporting on internal controls. So we have options available. We have 2 separate reports where we have the fairness of the entity's financial statements and their internal controls over financial reporting. And each report would be separately titled, dated, and signed, or we can issue a combined report that expresses 1 opinion on the financial statements and a second on the effectiveness of internal controls over financial reporting. And here we have an example of an internal control letter that is directly to the board of directors, and you see that Michael Scrum, LLP, is the audit firm.